Hello and welcome to the John Ark Show. Today's episode is called Discussing Upcoming Bank Collapses and Economic Crashes with asset manager and author Mathew Piepenburg. He's a commercial director at Matterhorn Asset Management in Switzerland and the co-founder of signalsmatter.com in the US. He has extensive experience in hedge funds, alternative investments, as well as credit and equity investing. He also has a book out called Rigged to Fail. Before we begin, I want to encourage you to subscribe to our channel for free. You can also like, comment, and follow us. We're going to have a lot of great celebrity interviews coming up, so make sure to click on that notification bell so you can be notified every time we upload a new episode. Also, we ask that you post a link to today's episode of our show on all your social media to help get the word out. Now, let's say hello to Mathew Piepenburg. Hello, Mathew. How are you today, sir?
Very, very well. A little bit tired, a little bit late here compared to your time zone, but lots to talk about. Great to be here.
So, Mathew, I understand that your plane just landed in Paris a few hours ago, and we've been hearing about the growing riots and civil unrest in Paris and throughout France over pension reforms. Did you see any signs of civil unrest coming in from the airport? And what are your thoughts on what Macron is doing with people's pensions?
There's a lot of points layered into that. I mean, it's unique to France. It's a system that really, the pension system is very important. It's a quasi-socialist country, and it's they call it the fonctionnaire system, where people who work for many years expect a certain pension, they expect a certain benefits, they expect a certain retirement age. And Macron has tried to lift the pension age from 60 to 62 to 64, and that creates a lot of tension for people who work for the SNCF, the trains, the hotels, any kind of EDF, the electrical systems. Anyone who works for the government or a government kind of sanctioned enterprise is expecting a certain retirement, a certain lifestyle that they've worked many years to have. And when Macron changes that creates a lot of social unrest. In terms of between here and the airport, no, but certainly between here and dinner, yeah, you'll see manifestations depending on the day of the week. Sometimes they're preordained, pre-programmed, sometimes they're spontaneous. The larger question really is, why is there social unrest? Why is there discomfort? It's unique to France and the pension system, but you'll see it in Italy, you'll see it in the UK, you'll see it in New York, you'll see it in San Francisco, you'll see it in Portland. The real problem ultimately is inflation is hurting people. The idea of their job security is hurting people. The idea of their currency is hurting them. There's fear and there's frustration. And as I said so many times, whenever you have a debt crisis, whether it's in France or the US or the ECB or the Fed, whenever you have a debt crisis, you always have a market crisis, you have a banking crisis, you have a currency crisis, you have social unrest, and then you have more control from the extreme left or right in politics. What we're seeing in France is a unique manifestation of French frustration, but it's very universal.
But it sounds like the good news is nobody threw a bottle of wine or a brick of cheese at your head while you came in.
Not yet. Not yet.
So Nouriel Roubini just announced on the Drudge Report that in his opinion, most U.S. banks are technically near insolvency and hundreds are already fully insolvent. That would indicate that they're operating in a state of undeclared bankruptcy. What are your thoughts on this?
Yeah, look, just in the U.S., because Powell has raised interest rates, when you raise interest rates, bond prices go down. When bond prices go down on the Treasury, whether it's a short-term or especially a long-duration Treasury, the value of those bonds goes down. We've lost across the U.S. banking system $2 trillion in assets. In the small banks, the regional banks, over $600 billion in assets. So on their balance sheets, their liability and asset side of their balance sheets, all U.S. banks have suffered a major loss. To Roubini's point, technically, they're not necessarily insolvent, but they're not profitable. They're not profitable anymore. The Fed has done a great job with the FDIC to try and contain the problems at Silicon Valley Bank or Signature Bank or First Republic. As a small crisis, it's been contained with money printed out of nowhere and at the Treasury to calm the psychological or the public face of the crisis. But if you look under the hood of the details, to Roubini's point, frankly, especially in the smaller banks who have a lot of poor loans on their balance sheet and a lot of discounted treasuries thanks to Powell's monetary policy, technically these banks are no longer profitable. And so when the Treasury bonds or the Treasury that's collateral on a lot of these bank balance sheets goes down in price, their loan books are very questionable. But when they go down in price, they're not profitable. And money flows out of these banks into the money markets where you can get more return on a 2-year or 3-year or even a 4-week T-bill than you can on your checking account or savings account. So these banks have to then increase their deposit rates to keep people in their banks, but that affects their profits. So they have to raise their deposit rates to make their depositors happy. And of course, depositors, if they're smart, we can get more money in the money market. So there's a real risk for the informed to just leave the banks. And that's the biggest fear right now at the US level.
So now we're going to get into some interesting areas. Now, you have a very strong understanding of the markets in general, and you also have a lot of experience with the management of ultra high net worth commercial and family investment portfolios. Many experts we speak with privately will admit behind closed doors that they've never seen a more corrupt, manipulated, or fraudulent stock, commodities, or crypto market than we have now. How would you evaluate what we're now seeing taking place in the banking sector and in the stock market in the U.S. and abroad?
Well, it's a bubble waiting to pop. It's a bug waiting for a windshield. And again, in all these areas, in the stock, in the risk parity markets, in credit markets, equity markets, real estate markets, and of course in banking sectors, there's so much corruption, fragility, and form over substance. When you look under the hood, and this is not exaggeration, it's not tinfoil hatted, it's just not mainstream, because most people either have their head in the sand or rightfully or wrongfully don't understand these things. And why should they? If you're a plumber, a dentist, a lawyer, a doctor, you have your own things to worry about. You're getting through each month, each week. But if you look at the markets with an experience, and not everyone has that because everyone has different backgrounds, but for those who actually take the time to look under the hood of the balance sheets of the Fed, the US government, or even the banking sector or the bond and stock market, which have been supported for years by mouse click money. Again, if any business or any family could go down in their basement, push a button and create instant liquidity or instant wealth, who wouldn't be addicted to that? But that's actually counterfeit solutions to a real problem. We have a major debt crisis in the US. We have 31 trillion heading towards 33.5 trillion in public government debt in the US. And you combine that with household and corporate debt, it's over 90 trillion. Debt is what keeps America going, but the cost of debt is rising. And this game of printing money to solve that debt problem can only go for so long. Eventually, the rubber meets the road, or the chickens come home to roost. And that's where we're starting to see the cracks right now. We saw cracks in the repo market in 2019. We saw cracks in 2020 in the sovereign bond market. We saw cracks in the gilt market in the UK last year. Now we're seeing cracks in the regional banks in the US. That's just the tip of the iceberg. When you're going to see cracks on Main Street, you're going to see more layoffs, you're going to see more defaulting loans, you're going to see more unemployed Americans, because companies that rely on cheap debt are going to close their doors. We've already seen it, Google, Amazon, Facebook, et cetera. That's just the tip of the iceberg. It's important that the public or the government or that the markets don't display this reality with total candor, because they don't want to create a fear spread. They have to use fancy words to hide really realistic and bad math. But it's not the end of the world. It's not the end of the dollar. It's not the end of America, but it's definitely the end of the bull run and the good times we've been enjoying since, frankly, 2009. It's simply coming to an end. That's just inevitable. It's mathematical.
When I saw Silicon Valley Bank implode, I immediately sensed that that nothing we were watching with regards to those banks was the surprise that they claimed it was. My suspicion was that there's much more going on with these collapses, and they may even be deliberately engineering the failure of these banks. What are your thoughts?
That's great. Is it causation? Is it coincidence? Is it stupidity, complicity, or is it something more nefarious? Henry Ford said, if Americans actually understood fractional reserve banking, or how banks operated, if everyone understood it, there'd be revolution in the streets, because banks take your deposit money and then they leverage it, invest it, risk it. And if they screw that up, then your deposits are gone, and it's insured to a certain limit, and then the rest is open to default. I can't say that it's intentional, but I do think the end game has always been clear. The end game is for smaller banks to be less important. The few large commercial banks, the too big to fail banks based out of New York, are going to have more and more power. But the real power, the real end game here is for the central bank to have the control, to centralize control over the markets. And, that is in and of itself antithetical to capitalism. This is what Henry Ford, Ludwig von Mises, Thomas Jefferson, Andrew Jackson all warned about. When the Fed, the idea of a national central bank having this much control over our markets and our banking system, that's the end of the capitalist system as we know it. That's not an exaggeration. Central bank digital currency, of course, is a symptom of centralized control. This is what happens as things fall apart, whether it's left or right politics, you get more centralized control. The ultimate game, as these smaller banks get eaten alive, as their balance sheets tank, and as bigger banks buy their good paper and give the bad paper to the public, you'll see more consolidation towards the bigger banks and ultimately centralized control by the US Fed. But keep in mind, the last time a country had one central bank that centralized control over the entire system was the Soviet Union. And so it seems hard to imagine that America, the home of capitalism, the land of the free, the land of free market price discovery, is actually tilting more and more towards a centralized control by a central bank, which is independent of our Fed, or excuse me, independent of our federal government. The idea that a central bank can have this much power and control of our markets is antithetical to everything the Constitution and free market capitalism stands for. This may seem hard to believe when everything still feels good, but we are not tilting tomorrow towards communism or Soviet system, but our mentality in the control center, the idea that the Fed can have this much control of our markets, that bankers can have this much control of our markets, is quite disturbing. And it's hard to imagine, as Americans accustomed to the facade of what America stands for, that's changing dramatically every day.
So while Nouriel Roubini estimates that before this is all said and done, another 200 more banks will implode, it's always possible that the banking system may completely collapse well before we hit that 200 number. Mm-hmm. Whatever the actual number is, how long do you think it will be before the government is no longer able to keep saving banks? Will it be a month, a year, or the day after the presidential election? What is your gut feel?
Well, technically, if you can print money out of thin air with a mouse click at the Eccles Building in Washington on Constitutional Ave, if you can create money out of nowhere, as a central bank can, you could theoretically support whatever bank you decide to support. You could support the system. You could even support the stock and bond market. But to do that, you have to print trillions and trillions of dollars. So technically, you can avoid bank failures by printing money to bail them out. But if you do that, if you save the banks, all you do is destroy the currency. So you either allow a bank failure or you bail out banks by printing more money at the Treasury, at the Fed, to save these quote-unquote institutions. But you do that at the expense of your currency. I don't think the Fed is interested in saving all the small banks. They are definitely interested in saving the markets and keeping power. And if they want to stay credible and keep power, eventually they're going to have to pivot from QT to QE, print more money at some point, at some crisis, another 2020 March moment, another 2008 moment. They will use a national emergency as a pretext to create more money. Whether they save all the small banks, they won't. They don't want to. They want to save depositors and bail out depositors to keep them from grabbing pitchforks. But what they'll do in the name of national security is print more money and dilute the currency. So it's death by dead currency as opposed to death by bank failures. Banks are already failing. Hundreds of banks have failed and will fail in the last few years and the next few years because they have poor collateral and poor loans. The loans at Silicon Valley Bank, notwithstanding their treasury exposure, were poor loans. No one would do a deal with them because no one wanted to buy their book. No one wanted to buy their book because they don't trust the loans. They don't trust the loans. They don't trust the economy. So it's a major vicious circle. Whether banks all fail at once or they fail slowly, the end game is centralized control, more central bank control. Central banks can print money. Theoretically, they can avoid catastrophe, but it always ends with the death of the currency, which is always the last bubble to pop. It's the currency bubble. It's the dollar in your pocket. It's the $100 in your account that bought X amount of items yesterday and will buy X minus 10% items tomorrow and the next day. That's an invisible tax. It's invisible poverty through inflation.
Now, at some point, the major investors and clients will wake up in the morning and they'll see another massive bank collapse. Where do you believe they'll start putting their money? Will it be gold, silver, or apartment building complexes? Where do you think they'll pump that money?
Well, first of all, they can always go to money markets, short duration treasuries, because they can get more yield on a 2-year bond than they can get on a checking account. And that's the big fear of the banks, is that the depositors will catch on and they can get a better yield on risk by going into the money markets and getting out of their bank accounts, especially if their bank accounts are only insured to 250,000. Anyone who owns more than 250,000 will just say, I'm going to take that extra money and transfer it somewhere else. And so there's that fear. Of course, depending on individual information, individual sophistication, they can put that money into farmland, into commercial real estate, which is, I think, farmland safer than commercial real estate. Or certainly they can put it into precious metals or other real assets. It doesn't have to just be monetary metals. Clearly, I have a massive bias towards monetary metals like gold, and I can talk about that. But the smarter, more informed, sophisticated investors that we work with are leaving the risk markets like stocks and bonds, the traditional markets, and certainly tech and they're putting into a new super cycle. The new super cycle is commodities. If you look at every bubble, whether it was 2001 or 1987, or you look at 2008, and you look at the current bubble we're in, but if you look at prior bubbles, when those risk parity portfolios, those stock and bond markets crash, money goes into real assets, commodities across the board, and commodities become the next trend up and to the right. It requires patience because commodities can be volatile in the short term, but the direction, the level of growth available in commodities market in general is going to be a huge cycle for the next 5 to 10 years as stock and bond markets lose their momentum and faith.
A lot of people are really worried about inflation. Some people think it's 10%, some people think it's 50%. What does your gut tell you? Where is the real level of inflation?
Well, it's certainly not the reported level. I mean, it's an open secret, not even a secret anymore on Wall Street, that the CPI scale used to measure inflation, which the Bureau of Labor Statistics is printing out every day, is pure fiction. If you use the scale that was used to measure inflation in the Volcker era in the 1980s, or even in the 1990s, the number, if you use the same scale that was more accurate then, that more honestly reported inflation, we would be right now at 15% inflation. We feel that, whether you're crossing the George Washington Bridge or whether you're buying groceries in Santa Barbara, you feel the inflation. The Fed has a great way of gaming the numbers, gaming the data. That's not sensationalism or conspiracy theory. That's just a fact. The CPI scale is like a fat camp where you go to, and even though you're gaining weight, they tell you you're losing weight. Even though your scale says you're losing weight, you can see your belly getting bigger and bigger. So they take out certain metrics to make it look like you're showing less inflation or getting less weight. But it's like a fat camp that says you're thin, but they don't measure calories from beer, pizza, pasta, chocolate, etc. They take those out. The CPI scale does the same thing. It takes out the things that are really expensive, measures them and weights them differently to tell you that inflation is lower than it actually is. It's a game. Or the Fed will target inflation at 4% rather than 2%. They'll play tricks to try and de-escalate the inflation fears. And we can certainly have disinflationary moments. Certainly if a market crashes by 50 or 60%, that's disinflationary. But when you're printing, when your M2 money supply goes up by 14 trillion in the last decade or so, of course you're going to have inflation. If I take this coffee and add a swimming pool of water to it, I'm going to dilute the value of that coffee. We've added a swimming pool of liquidity into the markets. It's diluted the value of the US dollar, which is only strong relative to other countries, but its inherent purchasing power, what it can pay for, is getting weaker by the day when measured against real assets like physical gold. So, inflation is far higher than reported. That's not sensational. That's just a fact. Everyone knows that. Powell, of course, and the politicians have to do their best to create an image of stability, so they'll report it differently. They'll claim to fight inflation, but they actually need inflation to inflate away their debt. So they're having their cake and eat it too. They're claiming to fight inflation by raising rates, but deep down they need negative real rates. They need high inflation to inflate away their debt. And then they'll misreport inflation by at least 50%. So it's a game. It's an absolute game.
What are your biggest clients most concerned about now, growth or principal preservation?
Look, whether I was in hedge funds or whether I was in precious metals, whether I was in New York or Los Angeles or Switzerland, the smartest clients, the smartest family offices, the first question they always ask is not how can I make more money? How do I preserve what I have? Most of our clients from 80 different countries are high net worth clients. They're generational wealth. The joke is how do you make a small fortune? You inherit a large fortune. But people who have a large responsibility, large amounts of money, if they're intelligent, they're not trying to get more. They're trying to protect what they have, because the way to make money is not to lose money. That's the key. And if you need to ensure the currency risk or the value of your markets or the value of your portfolio, the value of your accounts, you have to be diversified way beyond just classic stock and bond portfolios. You have to have a much more diversified portfolio. And first and foremost, you have to have insurance for your currency, whether that's euros, whether that's yuan, whether that's dollars, Canadian, Australian, or American, whether that's peso. If you're truly being advised correctly, as opposed to by someone who's just looking for fees, the best advice you give to the wealthy is how to preserve your wealth. Gold is certainly part of every intelligent portfolio, whether it's a 10%, 20 or 30 or 40% allocation. Traditional generational wealth always understood the minority position that no one else does, which is gold is essential to that portfolio because it's insurance against currency risk, and currencies are literally dying in front of us every day. Since Nixon got us off the gold standard in 1971, the value of all major currencies when measured against a real asset like gold have fallen by greater than 90% since 1971.
So amongst your largest clients, Prior to Silicon Valley Bank collapsing, what percentage of their portfolios did they allocate to gold and silver? And after Silicon Valley Bank, what percentage did they allocate to gold and silver?
With our clients, we only talk about their gold portfolios. And very few ask us about the rest of their portfolio. Even if I could, and I'm not trying to dodge the question, but I can't give insider advice on what our clients are doing. What I can tell you is our clients have always had a large portion of their portfolio in physical precious metals. How many or which particular clients were in the banking sector out, I can't say, and I won't say. I do know that certainly, based on our advice and based on the bond risk that we've been talking about for years, that this bond risk would spread to the banks. So very few of our clients were exposed to the financial sector pre or post SVB. That was just not an asset class that they would have been in.
Do most clients want to take physical possession of their gold at this point, or are they still comfortable with commercial storage centers and banks?
Well, our point since Matterhorn was founded was you don't want to, if you have large amounts of gold, you don't want to keep that in your home, for one thing, period. No matter how safe your home is, no matter how careful you think you can do that, that's incredibly dangerous as long as anyone knows you have physical gold in your house, no matter how safe. So we certainly would never recommend that at high amounts. The next thing is, well, do you hold it in a commercial bank like JP Morgan or Morgan Stanley? We certainly don't recommend that because that gold is supposedly in the accounts, but banks like JP Morgan and Goldman Sachs and Morgan Stanley can't help themselves. They'll say that that's allocated, segregated gold, but they hypothecate that and they lever that like they do every other asset. So when you actually need delivery of that gold, and again, this is not sensational, this is just a fact, what they say they have on the balance sheet and what's actually available at time of delivery is not there. So sophisticated gold owners always own physical gold in private vaults. The question is, which private vault do you choose? That's the hardest part. That's your biggest counterparty risk. That hole in the ground where you store that gold for a fee better be safe. It better be outside of your government's jurisdiction, so there's no compensation risk. But you also have to have complicit, absolute trust in not only the security of that vault, but the security of the people operating that vault and the credibility of that operational vault, because that's where your risk is. So sophisticated gold investors have to have a tremendous amount of trust in the jurisdiction and the operation of that private vault. And of course, obviously, we have the safest private vault in the world, and it's completely secure.
What makes it so much safer?
Just about everything. For one thing, even I can't access your gold in my vault. I can't get to it because there's so many checks and balances between that vault and our service. We can certainly audit your gold. We can certainly confirm it's there, but we can't access it without you being there or approval from someone by you. That's the first thing operationally, just the checks and balances. Physically, the vault is located so far in the Swiss Alps, non-disclosed, that once you get there, it's like a James Bond movie. You go through X and Y and Z levels of security to get to it. It's miles into the rocks, into the mountains. It's EMP proof. It's gas attack proof. It's nuclear proof. Even if I wanted to steal the gold, hypothetically, I couldn't myself get to it, even my own gold, without going through so many hoops. So you have to have physical security, you have to have operational security, and you have to have a jurisdiction that has a long and safe tradition of privacy, of legality, of operational risk, of anti-confiscation. You wouldn't even, if you're an American, want to hold your gold in your own country. If you're from Venezuela, if you're from South America or Asia or Northern Europe, you don't want to hold your gold in Finland if you're from Finland, or Sweden if you're from Sweden, or in America if you're from America. And you want it outside of your country's jurisdiction so they can't seize it, attack it, tax it, take it. So that's why we look around the world. There is no perfect place ever anymore. Even Switzerland has lost some of its neutrality, but relatively speaking, it's still the safest jurisdiction in terms of rule of law, tradition, and understanding the rights of its enterprises. We're a Swiss-owned enterprise. We're a Swiss-operated enterprise. We're not an American enterprise doing business in Switzerland. So we have so much more protections from foreign governments, and we have so much more support from the Swiss government because of that. So jurisdiction matters, location matters, safety matters, vault security matters, and checks and balances between, the person representing you and the actual physical gold matters. And it absolutely has to be your gold, not commingled gold, not shared gold, serial numbered gold in your name for you. You don't have to split a bar and cut it in half to get it to somebody else. It's always your gold, directly owned by you, and not with intermediary risk. Banks, commercial banks, even the most prestigious commercial banks, have so much intermediary and counterparty risk that it's ultimately, once you become more sophisticated, not the safest way to own gold. An ETF gold is simply not acceptable.
Right. So what is current Swiss law and your own Matterhorn policies? How do they respond to subpoenas from the U.S. or from the IRS or other federal agencies? What's the
Well,
current?
technically, yeah,
Yeah.
post 9/11 FATCA rules and international rules, we still in Switzerland still has a very strong rule of law. For to become a client of Matterhorn, you can't just throw millions at us and we'll take it and buy gold and put it in the ground and tell no one, because we have to make sure that there's compliance rules that even Switzerland has, especially Switzerland. Anti-money laundering. We have to be very clear the source of those funds. Those have to be clear. We have to go through compliance. We have to know the source of funds. We have to know we have to do basic due diligence that the money is not nefariously owned. So there's lots of times we have to turn money away if they can't show the source of those funds. So it's know your client, anti-money. So KYC and AML still apply in Switzerland. But once it's in our accounts, we don't disclose that to any other foreign countries. We don't disclose that to any requests unless there is literally an international subpoena that forces us to. For example, if the World Court or the U.S. says you can't have Russian gold or Russian clients on this list, we have to comply. And that's been a political move. We've never had that problem because none of those clients made it through our sifting process. But technically, Switzerland is no exception. If there is a quote unquote bad guy or politically sensitive person that's not allowed to have gold anywhere in Switzerland, we're no exception. We're not bending the rules for anyone. But that's not a problem with our clients. As long as the money is legitimately sourced from legitimate sources and from legitimate income or legitimate effort, whether it's inherited or created, clients have privacy rights in Switzerland that are far superior than any other jurisdiction. And the biggest fear, I think, lately for a lot of Westerners and Americans is, well, there's a war in the Ukraine. What if Putin marches into Switzerland, or what if Putin marches into Poland? I understand those concerns. We all do. But frankly, if Putin marches into Poland or Switzerland, we have bigger problems than Swiss gold reserves. What we're going to have is a world war. And frankly, there's no place from Uruguay to New Zealand where anybody's going to be safe. I don't think, as bad and cynical as I am about the events in the Ukraine, we don't see Switzerland, whether it was World War II, World War I, we don't see it any less safe today than it was then. I think it's easy for people not familiar with Europe or familiar with geopolitics to have a natural fear that Putin's just going to be a blitzkrieg into Western Europe. We really don't see that. But even if that were the case, our vault is safer than any other bank in Zurich. But even if that were the case, I think we'd see that coming. We'd have plenty of time to prepare for that. But there is no perfect location. No one can guarantee that. There's simply better locations. And certainly a private vault, the best vault in the world, is better than under your bed, in a closet, or even in a very good vault under your door, or hidden somewhere in your house. That is incredibly dangerous, in my opinion, in our opinion.
If Putin does send his tanks in your direction, you can just do what they've done in previous wars, and that is to go out and cut down all the street signs so he can't find the right roads. So if Germany's Deutsche Bank goes off a cliff, do you think the EU or even the American market can withstand that kind of shock?
I think the optics would be very hard. I think Credit Suisse was a dead man walking for a long time, and everyone saw that coming. And when it ultimately collapsed, well, UBS and ultimately the Swiss National Bank had to come in and do just what they had to do in America in 2008. They're too big to fail. Deutsche Bank may be too big to fail, but what does that mean? Again, when you solve that problem by bailing out bad banks, you're destroying your currency to create it. The ECB would have to print a lot of money to bail out Deutsche Bank. I think the population of Germany, in particular in Europe in general, would say we're really tired of bailing out corrupt banks. And no matter, even if the central bank could pay for that, monetize that in some way, they'd have a very hard time containing the resentment and the distrust and the disgust of the ganze Menge, the masses. They would say, wait a minute, here we go again, bailing out banks that have levered our deposits into risk, into derivative markets. They've failed, and you want us to bail them out because it's too important. I think there would be massive social unrest. It's already, Credit Suisse has been percolating for a long time. If Deutsche Bank fails in rapid succession, as it should, but if they try and optically, politically say, don't worry, we're taking care of your deposits, you're safe, depends on how many people will be sheep and how many people will be angry. And that's hard to say, but my guess is, just like post 2008, no one wanted to see another bailout again. I think it'd be very hard to bail out Deutsche Bank after Credit Suisse. But keep in mind, no one knows this, but when we had the COVID crisis in 2020, we had a bank bailout when no one saw it. It wasn't in the headlines. We had a bond market bailout under the guise of humanitarian concern, under the guise of COVID disaster relief. Trillions of dollars went back into the bond market. So they were saving the bond market, which is a way of saving the banks. It was much more politically viable to bail out the banks indirectly by bailing out the bond market in 2020 with printed trillions than it was to say we're doing another TARP program. But what you saw in 2020 was a bond market collapse that would have killed the too big to fail banks, but for the fact that the Fed was able to print trillions in 1 year to quote unquote respond to the COVID crisis. But what it really was responding to a bond crisis. They took a crisis like COVID, exaggerated it, exploited that to print trillions in a matter of months, not to bail out folks on Main Street. That's the story. The real thing was to bail out the bond market to keep banks alive and liquid. And that's my strong opinion. Yeah. Off the record, we all know that.
Do you believe that the five big super banks in the U.S. are really as strong as they claim they are, or is that more smoke and mirrors?
I mean, Jamie Dimon and J.P. Morgan of all the wolves on Wall Street has certainly got the strongest balance sheet, the most depositors, the most liquidity. They have a lot of treasury reserves, and they have relatively stable loans, more stable than other banks. The problem is they all have massive derivatives exposure. Derivatives market, as Buffett said, is the weapon of mass destruction. It's sitting there hiding like a ticking time bomb. And all the too big to fail banks have massive derivative exposure risks. They're basically playing a Mexican standoff and constantly churning to keep these derivative counterparty trades going that are hugely levered. If in a higher interest rate environment, derivative markets delever, or there's counterparty failure on the other side of those options and swaps, and there's a contagion domino effect, you could see large banks failing together. But again, the central banks, in the name of national security or economic stability, will come up with a very quick narrative of why they need to be bailed out. They are too big to fail. We're going to help them. It's not their fault. It's not our fault. It's some other person's fault. We'll bail them out. But again, the solution is not a solution, because the only way to solve a problem in any problem is now printed money or mouse click money, and that's inflationary and currency destroying. And when it comes between saving the banks or saving the currency, they'll always save the banks and the markets ahead of the currency. So at the end of the day, the ultimate party or the ultimate asset that's going to be hurt the most will be the currencies. Which is why, again, you say I'm speaking my book, but this is why precious metals, that tiny minority of the asset classes of the world, less than 5%, 0.5% of global assets are in physical gold. It's a finite asset of infinite duration. There's a reason. It's a critical existential threat to the currencies of the world. Politicians and banks don't talk about it, but those who've had the foresight to buy it for the long term, not for short-term trades, not for short-term speculation, but for long-term currency protection, will get the last laugh, as they have throughout history. And what we're seeing right now is the slow and then steady decline of currencies, like we've seen in Rome, China, Weimar, 1789 France. America's not immune. Europe's not immune. They're bankrupt countries. They're bankrupt banks. This doesn't mean it's the end of the world tomorrow or next week, but we're already deep into the reality of these sins that we're now reaping for years and years of living beyond our means and solving that with mouse click money. It's just sad.
Now, I'm not saying this is going to happen, but let's just go through a hypothetical simulation of what a banking collapse would look like. If they announced a banking bail-in tomorrow, what do you think the details would be? Do you think they would seize everybody's money at the same time, or just a select few? What do you think the details would look like of that sort of thing, and how much civil unrest would it trigger?
I think it's more subtle, because we're not Cyprus. We're America. We're the home of the world reserve currency. We're the home of the U.S. Treasury. What you saw at Silicon Valley Bank it was a bank failure, but really it wasn't a bank bailout like in '08. It was a depositor bailout. Technically, Silicon Valley Bank had a bad balance sheet. There was a run on that bank. Anyone who had more than $250,000 should have lost the rest of the money. That was the risk they took. The bank failed. That's their fault. And those who had deposits above the FDIC insured amount should have lost their money. That would have created pitchforks in Silicon Valley. And so if there was a major bank failure contagion in the U.S., I think the Fed and the Treasury would want to avoid that. So what they would do, like they did in Silicon Valley, is bail out the depositors and tell you there's no cost to that. So obviously, all the depositors in Silicon Valley Bank were very happy to see the FDIC cap raised and to see the Treasury bail out those deposits. But what people don't realize, if that happens at a larger scale, and as it already happened in Silicon Valley Bank, Biden, weekend at Bernie Biden, said that wasn't a cost to anyone else. That was us, the government, bailing out the depositors, helping the depositors. But don't believe that for a second. That money came from somewhere. It came from the Treasury. It's going to be paid for through IOUs from Uncle Sam, which is ultimately paid for by the taxpayers. So there, in a sense, it was a bail-in to bail out the depositors, which was paid for by taxpayers across the country and will be paid for down the road. So if more banks fail and they're supported and bailed out, the depositors are bailed out by Uncle Sam and the Treasury, ultimately it's people in Texas, Ohio, Michigan, Wisconsin, Rhode Island, Pennsylvania paying for depositors living in Brentwood, Silicon Valley, Malibu, et cetera. Ultimately, someone has to pay for that. It's an Uncle Sam IOU, which is ultimately paid for by Uncle Sam citizens, you and I. So there is no free ride. There is no free lunch. They can avoid a banking crisis by printing money, but it always comes down to the brass tacks of who's paying for that. At the end, it's the average citizen. So it does lead to social unrest. It does lead to frustration. It does lead to inflation. It does lead to an invisible tax. And the question is, how many people are becoming aware of that? And the more they become aware of that, the more angry they become. And that's what, the Fed and the media and the mainstream banks and the mainstream financial media wants to avoid. Understandably, they want to just keep the message calm. We're here to protect you. We're here to protect the banks. We're here. But the only way they can do that, since there's no tax receipts and GDP to pay for it, is to basically monetize these crises with money we don't otherwise have without a mouse click.
Now, most of the criminal world has a long history of concealing or hiding its wealth and its illicit business activities. They'll purchase legitimate businesses, which generate seemingly legitimate cash flow, but then that cash flow will slowly disappear over time. If the government introduces a central bank digital currency, what effect do you think this will have on organized crime's ability to keep hiding their money and their criminal activities? Mind you, we even have massive street gangs now in New York, Los Angeles, and Miami that are using crypto to launder their money. So if the government goes to its own digital currency, won't that just shed light on all these illicit activities? Or do you think they're too sophisticated at concealing everything?
It's a great point. I have very little good to say about central bank digital currencies. But one thing that is good, and this is what the Fed and the IMF and the BIS will tell you, is there is a great deal of security in the sense that everything that is paid for, used and bought and paid for with central bank digital currencies is very carefully monitored, which would mean, because one of the big criticisms that the Fed and the Treasury and the government has against Bitcoin is it's used by money launderers, arms traders, nefarious prostitution things, human trafficking, that Bitcoin, there's a lot of things that are Bitcoin are great, but what the government will focus on, because Bitcoin is also an existential threat to the dollar, they will focus on all the bad things that Bitcoin can do, like which is hide criminal behavior, right? And by having central bank digital currency, Bitcoin is out of the way. And now with central bank digital currency, criminals can't use Bitcoin and use these other things. They'll have to use a central bank digital currency, and therefore we can monitor and control the use of nefarious use of those central bank dollars. That's a positive story. Now, criminals will probably find other ways to barter other types of assets to get outside of the purview of central bank digital currencies. But the argument made by central bank digital currencies is, in addition to being a far more efficient payment system and a far more efficient way to settle and transact deals globally and internally, that we can stop the use of outside digital currencies for criminal practices. Well, that's true. If the whole world was forced to use central bank digital currencies, it would be much harder to transact nefarious arms deals, human trafficking deals, drug deals, et cetera. My bet is, to your question, cartels and money launderers and arms traders will find other ways to transact business outside of that. But assuming they don't, yes, it would definitely truncate their ability to do illegal activities. The darker side of central bank digital currency, of course, is those of us who aren't doing arms trading, human trafficking, drug trafficking. We're just living our personal and private lives like Canadians trying to protest Trudeau in Canada. If there's a central bank digital currency world and we spend our money in any way that threatens or disagrees with our government, they'll have the ability to track where we're going, what we're spending on, and turn that on and off like a light switch. And that prevents people from exercising their civil liberties and their free rights. So somewhere between civil liberties and the free rights and drug cartels and nefarious uses of currencies, central bank digital currency can fix one and hurt the other. So it's never as easy as it seems. There is a good side, a warm and fuzzy side to central bank digital currencies for the bad guys. There's a very dark side for the good guys, those of us who actually are spending our money fairly, but with no longer any privacy or control over our money. And that's a very dangerous side to CBDC.
Are the Chinese and the Russians still accelerating their accumulation of gold and silver, or has that tapered
Absolutely.
off?
Absolutely. Absolutely. The
Huh.
World Gold Council has no idea how much real gold the Chinese have been acquiring. We're talking 20, 30,000 tons. There's a massive flow of gold to the east. We see physical transfers all the time that aren't reported in the World Gold Council. There's also no doubt that just today, just yesterday, was announced these new deals between Brazil and China in bilateral deals outside of the dollar. You're seeing 41 countries in the world right now that aren't transacting in the dollar. We're seeing the petrodollar being replaced by a petro yuan. Slow and steady de-dollarization is happening all over the world. Part of the de-dollarization is a distrust of the U.S. dollar after years of being bullying the third world and developing economies for years. There's a great book called Confessions of an Economic Hitman that can spell it out very clearly. But in addition to de-dollarizing, they're looking for alternatives to stronger currencies than the dollar, gold-backed dollars. And China and Russia are chess players. America is a checkers player. They're thinking, and they have thought longer term. Eventually, their goal was to de-dollarize. The Ukraine war, the sanctions against Russia, gave them an even better pretext to make deals outside of the dollar, to distrust the dollar, because the US dollar has been weaponized. You can freeze reserve assets, you can take them off SWIFT accounts, take them off SDR access. So countries that were friendly or unfriendly to the US realize if the US can freeze Russian assets, they can freeze anybody's assets. We don't want to be hijacked by that dollar anymore. Now you're seeing the rise of the BRIC states, BRICS agreements. Developing economies all over the world are looking to do deals outside of the dollar. That's a watershed moment. I mean, 40% of all debt in the world is US dollar based. 60% of the value of all currencies in the world is US dollar. The US dollar is not going to go away tomorrow. It's not going to lose its world reserve currency tomorrow. But what is happening is one by one, countries are leaving the dollar. It's like a joke. If I owe you $1 million, it's my problem. If I owe you $1 billion, it's your problem. And at a certain point, the amount of debt owed to the US and more expensive dollars getting to the point where people are just not going to pay it, or they're going to find other ways around it. And so very slowly, very surely, Russia and China are creating financial war against the US dollar. And they're smarter than they look. And again, I'm not pro-China, pro-Russia. I'm just a realist. It's what I would do if I were the chairman in Russia or the chairman in China after years of seeing the US dollar rule the world. And the US dollar has lost credibility, lost faith, and has bullied the third world for years. People are leaving the dollar. Countries are leaving the dollar. Again, this is not overnight. This is a slow process. But the Chinese are very patient. They're buying up properties all over the world. They're making deals all over the world outside of the US dollar. Look, even Saudi Arabia is talking to China now. Saudi Arabia is talking to Iran. You're seeing things in every day on and
It's
off
the
the
financial
headlines.
twilight zone.
It's unbelievable. But as I said last February, and as Grant Williams said too, February of 2022 was as big a watershed as August of 1971. The genie doesn't go back in the bottle. When they sanctioned Russia by freezing their reserve assets, that might have looked good in the headlines as a political move against the freedom of Ukraine. But what it really was the end of the US dollar as a trusted currency. It was a weaponized dollar. And since that day, no one's going to trust it in the same way. And the US shot itself in the foot.
Now, one of the worst kept secrets in New York, Los Angeles, and other major markets is that there's an awful lot of fake gold and fake silver out there being purchased and sold.
Yeah, yeah.
When large clients, acquire large amounts of gold and silver, I'm assuming they do a certain amount of testing and scanning to ensure that it
Yeah.
is real.
Yeah, of course. I was at a
So,
dinner in Munich a few months back, and I was talking to a group that does gold verification. They're basically chemists and geologists who have a very high grade technology to audit real gold. And they were telling stories of going to people's houses, and outside of Munich, who had millions of dollars worth of gold. They said, we bought it off we didn't go to the Swiss refiners. We bought it in the open market, kind of under the table, but we saved a lot on the spreads. We saved a lot on fees. We got a couple million here of gold, and what they had was a couple million worth of nothing, because they didn't do their homework. They didn't check. So it's a real issue. Obviously, with Matterhorn, with us, we buy gold from the refiners. Argo, Heraeus, Pomp, etc. These are where 70% of the world's gold is refined in Switzerland. It's the highest fineness gold. So we make sure that it has a good source. And for those who are transporting logistic gold from, whether it's from Australia or the US into Switzerland, we have to have that gold verified. It is scary, because like Rolexes and Louis Vuitton bags, believe me, as gold goes up in price, you're going to see a lot more counterfeit fake gold. And unless you have the technology to audit it and verify it, you're buying horse crap wrapped in tinfoil, and you're paying for it, and you're thinking you're saving a few basis points by not going straight to the refiners or to the best gold sources, but you've got to be very careful. There's only so much gold. The stock flow ratio to gold is very, very specific. There's only so much gold that can be produced a year. There's only so much gold in the world. If you're buying large amounts of gold or even small amounts, you have to be very careful you're actually buying gold. That's a key issue.
If we continue to see an increase in the interest rate, how long before we see a substantial collapse in the real estate market? And if it does collapse, is that just going to accelerate the flight to gold and silver?
Well, again, last year you saw the largest nominal fall in stocks and bonds. In other words, stocks and bonds falling together at the same time. They're supposed to hedge. They fell together. That was the largest drawdown in stock and bond market since 1871. That's just in stock and bonds. Of course, already you're seeing stress in the real estate market, especially commercial real estate. As if rates continue to get higher, anyone who has to apply for a mortgage is going to stop or not be qualified. There's going to be an oversupply of housing and buildings right now. So there's an oversupply, less demand, higher rates. Of course, prices will go down. The only real estate that I would look at as a good safe hedge would be agricultural land, and a lot of that's already bought up by large conglomerates or private investors. It's very hard to become an investor in agricultural land. Residential and commercial real estate is definitely already seeing a pinch. It's going to get worse. We don't have the type of subprime mortgage crisis that we did in 2008. What we just have is overvalued prices in 2023. And so for smart buyers who have cash and don't need mortgages, it's going to be an epic opportunity to be all cash buyers at high-end real estate. It's going to lose value in high-end zip codes. But real estate in general is not a safe haven at the current prices right now. And if you're in an adjustable rate mortgage, that's very scary. And I think it's just common sense. But to your point, yes, if the Fed keeps raising rates, it's going to get harder and harder. I think the Fed will not be able to keep raising rates, though. I think at some point, more things are going to break. The Fed will pause. And ultimately, when we see a real uh-oh moment in stocks and bonds, the Fed will pivot.
Well, Mathew, it has been great having you on the show. Before we wrap things up, is there anything you would like to promote?
Not to promote, again, everyone worries that if you're a gold executive in Switzerland, you're just going to talk your book. Obviously, we've been talking for years about, why gold is a monetary metal and has to be seen as that. It's to us, it's a no-brainer. It's a high conviction trade. The only thing I would promote at this point, so people trust that that our advice is from conviction, not from talking a book, is look around. Do your own homework. Obviously, we've written a book called Gold Matters. You could say, again, that's talking your book. Read other books. Read other sources, not just ours. But become informed. I am quite convinced whether you trust a gold executive in Zurich or a gold talker in Texas, or whether you're looking at a hedge fund manager in Manhattan, if you talk to anyone who's being honest and who's being clear historically and mathematically, you're going to understand precious metals far better than you did yesterday. My advice is to get informed. Don't take my word for it. I invite debate. We invite the challenge. We have so much conviction. The only thing that worries us is how much conviction we have. But my advice is to get more and more informed, not just about gold, but about bond markets and bond signals, about market cycles, about historical inflation cycles, about historical commodity cycles. Do your own information without even listening to a word I say. You'll still come back to what Egon and I have been talking about for years. It still makes the most sense. You have to have some allocation in a real asset. You have to have a chaperone to your money. The U.S. full faith and credit of the Treasury is not enough anymore. You need a gold-backed solution. You need assets that can't be mouse clicked or printed, whether that's diamonds or gold or agricultural land or copper. That's up to you. But you have to think differently, but you have to think differently intelligently. So my advice is for people to get as informed as possible. And again, not take the word of anyone. Take your own judgment, become informed. You'll tend to agree with a lot of us very quickly.
And how many foreign languages do you speak?
Well, I was educated in Germany as a kid. I work in Zurich. I live in France, so I speak French, English, and German pretty well. But anyone who's heard me speak any of those languages will laugh at my accent. That's for sure.
Well, we're going to test your linguistic skills now. How would you say in German? How would you say the John Ark Show is the greatest show ever seen by man?
Die John Ark Show ist am besten Schauspiel, die ich in meinem ganzen Leben gesehen habe. Die beste wirtschaftliche Ansicht, die in deiner ganzen Leben sehen könnt. In Französisch, in French, you'd say, c'est le meilleur show que j'ai jamais vu dans ma vie. or in English, you could say it's the best show I've ever seen in my life. But that's just me asking you to answer a question or answering a question. I can't vouch for that. It's up to you.
Oh, everything was perfect up until that last sentence.
No, I've got to, no, I'm sure it's great. The more you can touch one investor at a time, the more we can get a ripple effect, the more we can influence people to think for themselves. There's a great quote by John Kennedy. There's nothing worse than abandoning your own judgment. I think people have to get more informed, and shows like this, platforms like this, off the mainstream media that allow people to listen to my and other opinions, which I invite. The more we can inform a non-mainstream, but objectively, mathematically honest, or at least sincere view, the better we can help people make their own decisions.
Well, Mathew, thank you for coming on the John Ark Show. We wish you all the best, and you're always welcome back on the show. And we hope that you make obscene amounts of money off each new crash and bank implosion that unfolds over the coming year or two. So,
well, thank you. I appreciate it. Appreciate the invite. Very kind of you.
Thank you very much. Bye-bye.
Thank you. Bye-bye.